Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about the next, we're going to probably go 20 minutes. It's going to be a short and Options Guide TV. We're heading into the holiday weekend, and you might as well get going on your weekend, right? Nothing's going to happen in the markets on a Friday before a holiday weekend, right? Well, I guess that's not the case. A little bit of sarcasm there, because the markets right now are down almost a couple of percent at this point in time. Volatility is back. We got the VIX index trading right now at 22.29. It's up $2 on the day. Unfortunately, our VIX trade is doing well, right? We looked at buying out of the money premium, and actually, like I mentioned, I did this in my own account. And we went out and looked at two different long call options on the VIX. And we're not going to be looking to sell that at any point in time. But two things to highlight on that trade is that the VVIX was down around 88, and we see the VVIX right now at 107. So that was part of the reason why the rationale behind buying VIX options is that the VIX of the VIX, the volatility index that tracks the VIX, was drifting quite a bit lower. And I think if you watch the show, if you go back and look at it, it was about 3 weeks ago. I was very just surprised, not necessarily that the VIX index came down, but that the VIX of the VIX, the volatility, the VVIX, had dropped so quickly to the lower end of the range. So that was enticing to buy futures contracts, or basically options on futures that go out. I think we looked at approximately 30 days and 60 days on our option contracts. And those are up today. The futures are up, but the futures haven't moved as much as the shorter term option, which is usually the case. Okay, so we did two earnings plays this week. And the one, this one really makes me sad, because I felt strong about Zoom Communications. The stock it's the Rodney Dangerfield of the meeting platforms. A lot of people use it. Across the board, I see Zoom being used on big tech for even large television production shows that I've been on. We've used Zoom for those type of scenarios, and they had a real strong quarter. As a matter of fact, their numbers were solid across the board. And we had a little bit of a run up going into earnings, and then it got sold off the day of earnings, and then got sold off after earnings. And I still don't quite understand it, but the trade that we love to do around earnings is the skip strike butterfly. And our skip strike butterfly did great once again, mainly because we received the premium. Remember, we always bill that as an alternative to doing a short call spread or a short put spread. We usually do the skip strike butterflies on the bull side of things, so we're usually using calls. And the trade, I'm going to send it. Let's run to the Tradier Pro software, and I'll first talk about that strategy. All right.
Share the screen again, Brian.
All right. Thank you. And in that strategy, what we have is Zoom at 88 and looking at the 90. So we're 4 points wide on this trade. And then we are 2 points wide we're 4 points wide on the long call spread and 2 points wide on the short call spread. So if we look at doing that trade, 88, 90, 92. Okay, that is with Zoom Communications. 83, okay, 88, 90, 92. So this would have been 94. Right. There we go. Okay, so when we did this trade, we got this done for a net credit to the account of first, this is 620. Why is it so far out? This would be 523. 523. 23. I don't know why that did not use the shorter term. All right, so now it's trading for next to nothing, and that's what it should be. So when we first put the trade on, stock was trading down around here. Send this to the what if. And we're trading down around 82. We sold the 88, had a benefit if the stock went from 88 to 90. That was 2 points wide. And then we were 4 points wide here. We were able to get this done for a net credit to the account of 20 cents. And you would have 20 cents on $2 worth of risk. So once again, we're looking at about 10% or $20 on a $200 margin requirement, which is a solid rate of return if the underlying stock stays where it's at, drifts a little bit higher, or to the downside. The main risk is if the stock skyrockets more than the expected move beyond 92 and up and beyond 94. Now, it's always enticing to do these on the shorter term trades because time decay is a big issue. And we had Zoom that was announcing on Wednesday after the earnings. You had all day Thursday, all day Friday. If the stock skyrockets up in the short term, you can get burned by the stock actually going inside your butterfly if it happens on the day after earnings, because implied volatilities are still high. You didn't have enough time decay. Now, if you were in a short spread, you would be really scared because you don't have a hedge. You don't have any protection against you. And you would just have to close out the trade or potentially roll it. But I don't think you would do that on a short-term trade around earnings. You would just close it out, take your comeuppance, and you would move on. Now, in this instance, you have this hedge. Now, Zoom did nothing, right? Well, actually, it's down about $2. It was trading at right around 83 when we put the trade on, and now it's trading at 81. So it still hasn't done much. There's no reason to get out of the trade. If the stock came running back by the end of the day and closed at 89 or 90, I mean, you'd be thanking the gods, right? Because you could potentially put this on for a 20-cent net credit and take it off for a $2 credit. I got it. And if we did that in that trade, we would be we'd be very happy. So here's the biggest thing about a skip strike butterfly is if the stock does go against you, it is okay to just keep the position on because you have the hedge. In the short call spread scenario, why would you keep it on? You would close it right now for a nickel, a penny, whatever you could close it for, you would do, and you would pay that because why have that risk hanging out there? But on the skip strike butterfly, there's really not much risk at all because unless the market stops trading and Zoom gets bought out overnight by Microsoft, right? The company that would probably be big enough to buy them. If that did happen, well, then in that instance, that's your only concern where the market might open up and you actually lose the maximum on the trade. So interesting trade. This one worked out. We did a long butterfly and we had someone on the show actually ask about why not do a put side of things. And I said, well, valuations are strong. It's a software company. Tariffs aren't as big of a deal. The trade war isn't that big of a deal. They all affect us in some way, shape, or form. So I want to get bullish. And I tried to pick a stock to get bullish on. So we looked at a butterfly and we talked about the 183, 189, 92 strike butterfly. And we were going to pay $1.58 for it. It still was quite cheap. You're getting 6 points of upside potential. If the stock went up to 89 from here to here, that's 6 points wide, paying $1.58, a nice risk reward. If the stock took off at the maximum upside, you could still make you'd make about $1.50. We were saying if you put it on for $1.50, the maximum this thing would trade for, if it blew through all your strikes, would be $3, implying that you could still double your money and make $1.50. Really liked the trade. Really liked Zoom. They did well. It's just an earnings thing. The numbers were solid, and we see the stock down 2 points. All right, Zoom. Now, the other one that we looked at was Tradier. And in Tradier, we did a skip strike butterfly. So here's our skip strike butterfly that we did in Target. Let's go here. The 23rd in Target, we had the 108, 110, 114. Once again, we got it done for 20 cents. So there's a pattern here, right? We all have stocks that are trading right around 100. And you're able to do these with the implied volatilities the way they were, way the market has implied volatilities, and getting these skip strike butterflies done for a decent net credit to the account. And sometimes that's not the case. In volatile markets, it's easier to do these skip strike butterflies and get a decent premium. So you're making 10% on your 2-point margin requirement that you would have to put up for that skip strike butterfly. And I'll just show you where the 108 is at right now on the 23 strike. You see that it's just trading for nothing. So there's nothing to show here. Once again, no reason to take it off today. If you did get a miracle and the stock came running up to 108, you'd be looking good. If we did do the bear put butterfly, that trade turned out pretty good, right? If you looked at doing our opening butterfly to the downside, that was not a bad trade because the market went down, and I was a lot more bearish on Tradier based off of the news headlines from Walmart and even Home Depot. I knew Target was going to struggle a little bit more than those companies. It's not as stalwart as those two companies in the retail space. I think those are the Cinderellas of the marketplace, or the kings, I guess would be a better way to say it. And Tradier got beat up a little bit, and that was expected. Okay, so we did the skip strike butterfly. All three of the trades worked out. If you stuck with the skip strike butterfly theme, I'm sad about the Zoom one. I actually was in a long call spread because of the way that I had the position on in my trade. I still have about 20 days left in my long call spread on Zoom. So I'm still hoping that the market will come back, but that's the trade that I ended up doing. And here's the way that I got into Zoom is I was long a call going into earnings. The stock ran up, but it didn't run up enough to take the call position off. And when it dropped down a little bit, I sold the call option and remained long a call spread going out. I think we're going out probably the June 20th expiration. It's probably the June 23rd expiration. All right. And with that said, struggling with the screen share. So I think we'll leave that there. Solid week of earnings trades. Gosh, if you don't count the Zoom long call butterfly, right, the actual call side of things, and you think that we put the trade on and looked at the skip strike, I think it was about 5 in a row. If we go back and look at the trades, as far as the skip strikes were concerned. So solid week of earnings. I'd like to get back to be able to do some SPX trades. The markets are really tough because of the news headlines and when you're going to do them. But if you're looking at butterflies in the SPX or even long or short call spreads, and in the SPY, the risk reward ratios are interesting because of the skew in the marketplace, or otherwise sometimes referred to as the tilt. The out of the money option contracts, and especially on the put side of things, and the SPX are trading at much higher vols because people are using them to hedge. And they're just interesting trades, but it's so hard to get the direction correct. We get good news, and then all of a sudden we got bad news. And Apple is now driving the markets lower because they got some tough decisions to do. Apple's down 2.64% on the marketplace, and we got the S&P 500 index, and it's bounced a little bit now. The SPX is now down 1% at this point in time. It was 1.5 on the open. All right, thanks for tuning in. Don't forget, Monday is a market holiday. We'll see you next Wednesday for the next edition of Options Guide TV. On Monday, I did a special event covering cash secured puts in the volatile marketplace. So Education Monday this Monday, Stop in, check it out, and we'll see you live again this coming up Wednesday at 11 a.m. Eastern Time inside the Tradier Hub, hub.tradier.com for the next edition of Options Guy TV. Thanks for tuning in. Enjoy yourself and be safe out there this weekend.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.